Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The May corn contract has been channeling right on top of our support level of 366.5, which was previously resistance. 366.5 is a 90-degree threshold, and as the market continues to bounce against this level over the last week and a half or so, what we'll see is that we expect the market to continue to be sideways. One of the things that's important to notice is that we are now right in between volatility-based support and resistance. And this is actually a very key spot to put on a straddle type of trade, where the market can actually eject in either direction. We're predisposed to thinking right now that the market will continue to channel sideways for the next week or so, especially as we're approaching the end of this shortened week because of the Good Friday holiday. But then coming into next week, we'll probably see some volume come back into the markets, and at which point we expect that after the market finishes its channeling phase, we should see a market that moves back down again. We have support underneath at about 347.5, and if the market breaks below there, we could see a move down to about 330 going into the early summer months. Interestingly enough, just a moment ago we saw that our support was at our 90-degree level, but resistance has been right at our point of control standard deviation level of 373. So this has been the area that has really contained the channeling for the market. Now, you'll also notice that the market now is approaching our natural angle from our geometric shape. Once the market is now able to get through this area, one of two things can happen. This can actually become a type of support for the market for him to channel up against, or upon breaking it, we could see where the market then turns back down to retest previous lows. Previously, we had a double bottom here, but double bottoms rarely terminate markets. And so what we'll probably see here is this double bottom that people have taken for this move up. Once it finds some exhaustion and perhaps hits resistance up ahead, it'll then turn back down, give us a false break around that 340 to 350 area, and possibly below that going into the early summer months, as mentioned before. We'll notice much of the same here for the December contract. It's banging around or oscillating around the 386 number, and our highs and lows are basically pretty equidistant either side of that. As this consolidation occurs, the market will continue to make its move. You'll notice here that it's overbought. So in all likelihood, this lower double top that we're seeing here should lead to a move down for this market. You'll notice here on this chart, we have our natural angle that has been very good resistance for him. And in addition to that natural resistance, you'll see here that current prices are roughly at about 385 or so, which is just shy of the 391 point of control. That is our perfect level here for the overhead resistance. The market's going to need to get above that 391 if it's going to get some legs, but in all likelihood, as we can see right here, a lower double top, in all likelihood should lead us to a move back down. We like the way in which soybean has been following our analysis here. We've had volatility-based support coming in for the market right along its lows. And as the market has traded along that bottom here, we had a cycle timeline around December 30th or so, next cycle timeline around March 4th. The market basically returned to that same price along that cycle. Now we have our next cycle timeline coming in at about March 24th, and the market has made an advance inside of that direction or inside of that time threshold. Upon reaching this area, plus or minus a couple days around it, in all likelihood, we can very well see a reversal in the market. And so we really like the way it's moved straight up into this area here, which happens to coincide with our 360-degree mark of 909.5. And once that market gets inside this area here, we would not be surprised to see the markets come in and make a nice move down, given the fundamental information at our disposal. We're in the midst of harvest right now in Brazil, and the inventory has been very large, and so there is very little to justify continued advance to the upside for the soybean market. Here we'll notice how the market is moving along our natural angles. We have previous high here that is actually going to pose as very good resistance for him as he is channeled along. He's right up above a natural angle, but this point of resistance is going to be very key. And once the market breaks down, if it breaks this angle here, we really believe that we could see a very nice move to the downside. November, you'll notice here, is very textbook. We had drawn our new geometric shape for him coming off of this low. The angle right here is the basis of our initial signature for the move. And you'll notice how the market very naturally traced up against this level, straight up into our 180-degree mark of 923.25. Now, this intersection point could pose as a potential point of resistance. The market came in, touched that level, and today you can see is actually trading down. So what we'd be looking for is for the market to trace back down. If he's able to hold 893 or so, we could see a small bounce, but in all likelihood what we'll probably see is a slow move down, maybe a small bounce inside of here with a continued move to the downside again. Much of the same for November beans by way of our geometric shape. We have a nice point of resistance up ahead. The market's now sitting right on top of natural support / resistance. Current prices now are at about 915, but we have major resistance at 940 up ahead. But the next standard deviation below that level is 906.18. And so what we'll notice here is the market came in, found resistance, turned back down, and upon breaking 906 or upon breaking 900, let's say, that would probably be good confirmation for us that the market's ready to start giving off some of the nice advance that we've seen over the last month or so. Last week we pointed out that the July wheat contract is a very nice short opportunity hitting up against our 180-degree mark. Shortly afterwards, the market actually did have a very nice rundown after that price threshold. It coincided with him being overbought, and it was only natural for him to come down, and he found support at our 270-degree mark. It has since bounced from there, but you can see the weakness is still coming into the market. And so really for wheat, we anticipate a move back down to test previous lows and perhaps to come in and test about 448 or so. A couple key levels to keep in mind. Current prices are sitting right at about 473.25. We have 471.5 as one standard deviation below the point of control. And so upon breaking 471.5, the market will probably make a move down to 449.25 or so at a minimum. Previous lows sit at about 450, and so we would eagerly anticipate that the market should continue to run to the downside. Lastly, today we'll take a look at the crude oil market. The previous contract has gone ahead and rolled over, so we translated our data onto the new contract here. We continue to like the April 8th as a key date. The March 11th date was a very nice turn date for this guy, albeit for only 2 days, and the market came back up again. What we're looking at right now is probably an advance into that April 8th timeline if the market's able to hold above 389. So if we see a correction here that comes in, holds, and bounces back up, we'd be looking for the market to make a potential nice resistance near that 44 number for this contract. Now, upon getting to that area, if this contract's able to get to 44 near or around April 8th, we believe that this is going to be a very good shorting opportunity for the crude oil market. It will at that point be up against a very good volatility-based resistance potentially. And so we have a very nice spot after what has been a very good run up. In addition to that, we ran a couple metrics on this move here. So this leg that we saw here was the initial impulse off of the low, followed by a pullback. Using a Fibonacci ratio scale, about 1.618 of this range is where we're sitting at right now for this advance, and so it closely ties in with where price action is currently at. So upon reaching this area here, we could actually see a very nice move in terms of a correction for the market to come in somewhere between 1.618 to twice this advance to find some really good resistance up around this region here that would tie in with the potential cycle turn time. We are only a few days before Good Friday and Easter hits. We hope you have a great holiday time. Thank you for joining us and look forward to updating you again next week.